Have you ever really stopped to think about what goes into sizing up a huge global company, especially when, you get completely different advice from experts?
Yeah, it happens. Like one really detailed report is shouting buy, and then another one, just as solid, is flashing sell signals.
Exactly. How do you even begin to make sense of that? Well, today, that's what we're doing. We're taking a deep dive into Danaher Corporation, DHR. They're a global powerhouse in life sciences and diagnostics.
Right. And what makes this fascinating is the material you've given us. We have this really comprehensive BUI thesis talking up significant upside, and then this strong avoid sell report that raises quite a few red flags.
A real contrast, isn't it?
Definitely. It sets up a great discussion for us to unpack.
So our mission today is pretty clear: distill the most important bits from these detailed reports. We want to give you a clear, balanced picture, the exciting potential, and the serious cautions around DHR.
Yeah, help you understand what really matters in these opposing views so you can walk away feeling, well informed.
Okay, let's dive in. Let's kick things off with the bullish argument. This view frames Danaher as, like, a really attractive entry point for long-term investors. As of late, July 2025, the stock was around $205.60.
And the bulls see a lot of runway from there. What jumps out immediately in their report is Danaher's core business strength. I mean, over 80% of their revenue, it comes from recurring consumables.
Right, like the printer and ink analogy almost.
Exactly. But for highly specialized fields, bioprocessing, life sciences, diagnostics, and this isn't just, hope. It's backed by what they call regulatory lock-in and customer switching costs.
Meaning it's tough for customers to just swap them out.
Extremely tough. Think about labs or biopharma companies using Danaher's filters or specific cell culture media. Switching means huge costs, regulatory hurdles, revalidation. It creates a very sticky customer base.
Okay, that makes sense. Sticky revenue.
And the numbers are showing a rebound, too. Core revenue actually returned to growth in 2025, and management even bumped up their full-year EPS guidance earnings per share to $7.70, to $7.80.
Yeah, after a big earnings beat in Q2, right?
Yeah, a 9.8% beat. That's a pretty strong signal, that operations are recovering.
So that strong recurring revenue points to resilience. But what about the market itself? The opportunity they're chasing, especially in bioprocessing.
Oh, it's huge. Bioprocessing, basically making future medicines, is projected to grow at almost 12% a year through 2033. That's massive compounding.
And Danaher is positioned to catch that wave.
Ideally positioned, according to the bulls, their Sativa and PAL units are set to ride what they call an inflection in biologics capacity spending. Basically, as the world needs more advanced drugs, Danaher provides the essential tools.
And management feels good about this.
They're expecting high single-digit long-term growth here. And look at their market share. It's dominant. Over 40% in chromatography media, over 25% in bioreactor hardware. That's serious clout.
Wow. So not just participating, but leading.
Definitely leading. And their H2 2025 order book, it already supports that high single-digit core growth, and consumables are showing double-digit gains already. The underlying demand is just, exceptionally robust.
Okay, so strong business, big market. Let's talk financials. What does the Bull report say about valuation and balance sheet?
Right, so the valuation, it's trading at about 43.6 times trailing earnings, 25.3 times forward earnings. Now, the bulls argue that this already reflects a cyclical trough in margins.
Meaning the market has priced in the bad news on profits already.
That's the argument. It suggests that as margins recover, which they expect, the stock has significant room to run. Maybe 20–25% upside just to reach the median analyst targets of $244, $260.
And the financial foundation to support that.
Oh, yeah. Super strong balance sheet. Low debt to equity at 0.32. That gives them over $15 billion in firepower for M&A bolt-on acquisitions or even share buybacks.
$15 billion is a lot of flexibility.
It is. And look at their free cash flow conversion, 143% year-to-date in 2025. That's incredible, generating way more cash than reported profit. Fantastic sign of health.
So that feeds into their competitive advantage score.
Exactly.
Yeah.
It all contributes to that wide moat score of 810, really reinforces how hard it is for competitors to challenge them effectively.
Okay, that wide moat score.
Yeah.
It sounds like there's something unique about how Danaher operates. You mentioned the Danaher Business System, DBS.
Ah, yes. DBS. That's kind of their secret sauce. It's this whole proprietary system based on lean manufacturing, continuous improvement, operational excellence.
And it actually works. drives results.
Consistently. It systematically drives 100 to 200 basis points. That's 1 to 2 percentage points of operating margin improvement within 3 years after they buy a company.
So they buy good companies and make them even more profitable.
Precisely. It's key to their whole portfolio reinvention strategy. They buy leaders like Sativa, Aldebaran, integrate them with DBS, boost margins, and then sell off slower assets like dental in 2019 or environmental in 2023.
And that strategy has paid off.
Massively. It's compounded shareholder returns at 21% annually over 15 years. The S&P 500 did 10% in that time. Big difference.
21% CAGR is impressive.
It really is. And they're not done. They expect another $150 million in DBS savings to add 100 basis points of operating leverage by fiscal 26. So profits growing faster than revenue. It's like engineered growth.
Engineered growth, I like that. It's built into their system. What about external validation? Do analysts and big investors buy into this story?
Oh, absolutely. You've got 79% buy or strong buy ratings from analysts. Average price target $244, implying like 22% upside from that $205 level.
And the big institutions?
They're in. Vanguard, BlackRock, Wellington. Together, they hold over 18% of the shares. And get this, $16.2 billion in cumulative inflows over the last 12 months. That's serious conviction from smart money.
Wow, that's a huge vote of confidence.
It is. And you have to credit management, too. CEO Rainer Blair navigated really tough supply chain issues and still delivered 27.3% adjusted operating margins in Q2 2025. Pretty impressive.
So, the bottom line from the bulls.
Their base case sees the stock hitting $255 within 24 months. That's about a 24% total return, including the dividend. Key things to watch are bioprocessing orders picking up later this year, more cost savings from DBS, and maybe some smart M&A.
Okay, so that's a very compelling picture, isn't it? Strong fundamentals, proven strategy, big market tailwinds. Sounds like a winner.
It certainly paints that picture very effectively.
And it's a big but. Here's where it gets really interesting, because even great companies face headwinds, right?
Mm-hmm.
And not everyone is singing Danaher's praises. We have this other report, the bearish view, offering a sharp counter-narrative.
Indeed. And the bears raise some pretty serious concerns, offering a stark contrast to everything we just heard. Their first big red flag, revenue stagnation.
Stagnation after all that talk of growth.
Well, look at the numbers they highlight. Full year 2024 revenue actually slipped to $23.88 billion. That's down 10.5% year over year. And the 3-year growth rate, negative 6.76%. Even their adjusted core revenue fell 1.5%.
Okay, that's not great.
And on top of that, gross profit margin compressed sequentially down to 59.5%. So falling revenue and shrinking margins, yet the stock, they argue, trades at nearly 40 times trailing earnings.
Which they see as too high.
Yeah, they see it's a premium valuation compared to history and peers, especially given these headwinds, overvalued in their view.
Are there specific performance issues they point to? More red flags?
Definitely. They highlight recent earnings misses. 4 out of the last 5 quarters apparently delivered either EPS or revenue disappointments. Remember that 14.5% share price slide in 5 days back in February 2025? That was triggered by one of those.
Right. I remember that dip.
And margin compression is a big theme. Adjusted operating margin guidance for Q2 2025 was 25.5%. That's quite a step back from their own long-term goal of over 30%.
And what about that free cash flow conversion we liked earlier?
Well, the bears point out that annual free cash flow fell significantly in 2024, down to $5.3 billion, which is off 28.4% from the 2022 peak. So, while recent conversion might look good, the overall trend in cash generation has weakened. That gets attention.
Okay, so revenue, margins, cash flow concerns. What about broader challenges?
Yeah.
Strategy.
Yeah, they bring up other things. There's apparently a litigation issue, a Delaware derivative suit where shareholders allege executives overstated growth prospects after the COVID boom.
Ooh, legal overhangs are never good.
Not ideal, no. It could be costly. They also talk about competitive erosion, pointing out that Thermo Fisher now has a much larger slice of the life science tools market, almost 50%, versus Danaher's 27-28%. That gap is widening.
And strategic moves. We heard the bulls praise the portfolio changes.
The bears have a different take. They see the Veralto spinoff, which was 16% of 2022 revenue, as poorly timed. Divested at the bottom of industrial valuations, they say, which hurt diversification just when their core biotech business hit a rough patch.
Timing of everything, I guess.
And capital allocation gets questioned, too. Remember those buybacks the bulls liked? The bears point out that the $3 billion spent repurchasing shares in 2023 was at an average price of $276.
Which is way above the current price.
Right. Those shares are now about 26% underwater. From this perspective, not the best use of capital at that moment.
Okay, so even the lauded DBS and capital allocation aren't immune from criticism. What about that bioprocessing recovery?
Strong skepticism there. Despite what management says, the bears point to Q3 2024 when bioprocessing revenue collapsed down 20% globally and a staggering 45% drop in China.
45% in China. Wow.
Yeah. And China itself is a concern. It's about 12% of sales, and it's facing these government-mandated price cuts, volume-based procurement, or VBP, up to 30% potentially. Plus, more competition from local Chinese manufacturers.
Tough market then. Any other risks?
Tariffs. New U.S. tariffs on biopharma components could potentially shave $350 million off revenue and maybe half a percentage point off margins next year. So quite a few headwinds stacking up.
Okay, so given all that,
Mm.
what's the potential downside according to this report?
It's pretty significant. Their base case target over 12 months is $150. That's a 27% drop from the $205 level we mentioned, assuming flat revenue and margins around 25%.
And the worst case scenario?
Their 24-month bear case is $166. That implies nearly 50% downside, like
Wow.
negatively 48%. That assumes revenue actually shrinks a bit each year and margins fall further to 23%.
Ouch. That's a dramatically different outlook.
Completely different. Their conclusion is stark. The risk-reward skew is decisively negative. They believe decelerating markets and these execution issues point to significant potential downside despite Danaher's historical strengths.
Okay, wow.
Yeah.
We've just walked through two incredibly detailed, but just fundamentally opposing views on the same company, Danaher.
Yeah, it's quite the contrast.
On one side, you've got this picture of durable growth, that wide moat, smart strategy in a booming market, the compounding powerhouse idea.
Right. Poised to really capitalize on bioprocessing growth.
But then, on the other side, you hear about revenue slowing down, margins getting squeezed, legal issues, competition heating up, real cracks in the foundation.
Exactly. Suggesting maybe the recent past isn't indicative of the future, and there are serious risks ahead.
So, stepping back from the details, what does this clash tell us?
Well, I think it really highlights how crucial it is to look beyond just the headlines, doesn't it? You have to dig into the specifics, the good data points, and the challenging ones.
It's not just about picking a winner between the bull and bear case.
Not at all. It's about understanding all the forces at play. The reasons for optimism, sure, but also the very real reasons for caution. You need that comprehensive view.
So what does this all mean for you, listening in? I guess it means that even for a company with a really strong track record like Danaher, the future is, well, it's never guaranteed, is it?
Never a straight line. There are always different ways to interpret the data, valid reasons for optimism, and just as valid reasons for concern.
Which brings us to maybe the key question for you to think about. How do you weigh these kinds of contrasting elements?
Yeah, when you look at a company like Danaher, what grabs your attention more? Is it the long-term strengths, the proven playbook, the huge market opportunity?
Or are you more focused on the recent bumps in the road? The competitive threats, the margin pressure, the potential risks lurking around the corner.
How do you balance that long-term picture against the near-term challenges?
It really makes you think, doesn't it? How you'd navigate this information if you were the one making a decision. How the same company, the same data can lead to such incredibly different stories. Really need to consider both sides.